we're looking at the world coming to an end, Pavel. How are you?
Hi
Welcome
Dale,
back.
thank you for.
So this is why you trade wheat spreads to avoid all this volatility.
Yeah, exactly. I mean, I've been pumping these uncorrelated opportunities for the entire year, and probably maybe even last year. So that's the reason. So it's a way to avoid the macro uncertainty, at least if we do not have a liquidity crisis, because when you get a liquidity crisis, then everything comes down the drain. So,
Yeah.
but we are not there yet.
Well,
And
I'll tell you, I may as well, put it out there. But Joseph Wang, the guy who worked at the Fed Guy 12,
mhm.
just wrote a recent piece, and he's not an alarmist. So, but he's saying that because of certain aspects of different structures, that the risk of a liquidity crisis is out there now. And so, if he's talking about it, then he sees what the engine is doing inside the engine. So something for us to be aware of. Maybe we're looking at a little bit shades of it today with risk off. Everything's lower except the
Mhm.
dollar, right? So anyway, it's I'm here to find out what you're thinking, buddy. So how did that Kansas City Chicago wheat spread work? How did it work out for you?
Uh, I did not trade that personally because I'm no longer a trader. I'm focusing on a more longer term opportunities. So maybe I would call myself investor, which is something I never was. So that's to be honest. But let's check it out. I hope I have it somewhere. So this was the original spread. Maybe we can move to December expiration. And let's switch just to the price itself. And I think we were talking about this at the beginning of June. So yeah, it went up
Side, yeah,
somewhat, but
yeah,
overall it was a sideways action. So
yeah.
it was not a
Well,
total failure, but I was expecting more from it for sure.
well, it was better than being long wheat, which I've been looking for a bottom. Maybe we have one now, but there've been several since you and I talked, false starts
Mm,
for a wheat rally. So, sometimes making a little, not sometimes, all the time, making a little is better than losing a lot.
exactly, and I was
People don't, that
proposing.
doesn't show up on your P&L.
Exactly. I was proposing this opportunity exactly as a better way how to play the wheat market, and it
Right.
turned out to be a really better way because, as you said, wheat has continued to move lower. Not to mention the contango, which would act against any long position in wheat. So from this regard, it was a success.
Okay, so what's top of mind now for you, Pavel?
Yeah, I was really trying hard to come up with some perfect opportunity, but
Well, they don't exist.
yeah, they don't exist. And whenever I'm trying too hard to force myself to come up with something, it's usually a flop. So I decided I decided against looking for a certain single opportunity.
Well,
Uh,
I see something in your research box right there because
mhm.
I've been saying that the miners were going to continue to get cheaper and they were keeping me from being bullish the metals. I'm still looking for lower levels. But you have something there on silver mining costs, but that was the second quarter. You track that, and because what I'm feeling right now, Pavel, from a
Mhm.
sentiment standpoint, you know how disappointed silver bulls are. Everyone's waiting for the short squeeze.
Mhm.
So those are the physical guys. So, and I've even interviewed guys, and I asked them about the miners, and one guy said, who's a good technician, he said, "Why do you even want to invest? They're lousy businesses." So the sentiment, if it's negative in the precious metals right now, it's that much more negative in the miners, which have way, way, way underperformed the physical market. You seeing anything there, contrarian wise?
Not yet.
Or
I think,
or are costs going back up because energy is going back up?
yeah, definitely the costs are going back up because there was a surprising drop in silver mining costs. I think it was in the first quarter, if I'm not mistaken. And in the second quarter, the costs went back up to, I think, $17 for the data set I'm watching. So the costs are basically back to the level they were last year. But we are still far from the level where there would be pain for the miners, because the best long-term buying opportunities in silver were when the mining costs, or when the price approached the mining costs, and a lot of the miners became unprofitable. And we are not there yet, far from that. So there's definitely more room for further pain to explain the situation. But there's no guarantee we must get there. These occasions are quite rare. So I do not, say that this must happen. But just
well, I'm just saying that what I noticed from just the vibe in the air and the people that I talked to, a lot of people that were, bearish stocks, they've been hiding there and they've been getting killed. And what they were trying to save by not being in US equities and tech and stuff like that, they gave it up in the miners. It was no protection for them because it's all one market anyway. And they're people that love them long term barely want to talk about them anymore. So
that's
they're
true.
the most unloved group through my interactions with traders and analysts, most unloved group out there. Maybe bonds are, but silver ranks up there.
Yeah, but it's not surprising
heartbreaker.
because the current environment is outright bad for miners. The high inflation, when the energy prices are going up, when there are labor strikes and higher for longer and so on. This is squeezing the miners, because even though gold and silver prices are not exactly low, their costs are rising faster than the price of these metals. And if you want a perfect indicator for that, just look at real yields. Real yields are rising, and that's not a good environment for miners. So I think people should not be surprised by this. And what I really think is funny is when someone is pushing oil to go higher and miners at the same time. It's incompatible, unless we get a hyperinflation, of course, but we are nowhere near that territory. So if we get a higher inflation or even high inflation, that's not exactly good for miners. It's good for
what silver needs is not the force of inflation. It needs a bear market in the dollar. Okay, so that's what I think is driving down the price of everything. And when the dollar's good, what can you be long right now with the dollar strengthening for the last 7 weeks? Some equities, but they've rolled over. Bonds aren't getting a bid. Precious metals are getting hit. Commodity markets are under pressure. So it's all about the dollar, isn't it?
yes
Yield,
and no.
dollar.
Yeah, my opinion is slightly different. I think it's not just about the dollar. In my opinion, the real yields are more important right now, even more important than the dollar. I can even imagine gold and dollar going up together. Maybe not silver, and silver can go sideways or drift higher. But this is due to the situation around the world, the geopolitics, and the risks out there. So I think, or at least for me, I'm watching real yields more than the dollar with regard to the precious metals. So because people, when I think people are currently happy holding the dollars because of the high yield, but they also have the geopolitical risks in mind. So when this relationship turns and the real yields start to head lower, people can suddenly discover gold to offer, some appeal to them. But that won't happen until we get a reversal in real yields.
Okay, well, let me know when they ring the bell.
Yeah,
So, it's okay, everyone, it's safe. It's good now. So I see you have copper up there. We have a major breakdown in the copper, that massive triangle we finally broke down today. So, are you talking about taking advantage of lower copper prices with what we have in the upper left-hand side?
Not yet. I would prefer to ride the trend because, like I said, I do not see any good opportunity right now besides the dollar. But even the dollar is something that's, the best opportunity is already behind us.
The
So,
Dr. Copper is being sued.
yeah.
Yeah, for impersonating a bull market.
Yeah, but
Because a lot of people have been buying, copper's the new gold and we need copper and copper shortage. So anyway, I'm just letting you know that Dr. Copper, um, you know, better get his flu shot, but it looks like another 10 cents or lower is possible to me.
yeah, I think even more. And here is the post from our Twitter that is from 2 weeks ago, which basically summarizes our bearish outlook. These are the interdelivery spreads on copper zoomed out, and we asked a rhetorical question: what do you think comes next? Which was a follow-up to a bearish post where zoomed in these copper spreads were already moving lower while the underlying was drifting higher, and we were clearly bearish. And today's breakout is just confirmation of this outlook. So when I open these spreads again and show you the same chart, this major divergence will be resolved in one way or the other. And as we told our followers on Twitter, we expected the copper price itself to play a catch up, which it is doing right now. And I think, or I would not be surprised by even larger move lower than 10 cents. I think we are currently breaking down from this consolidation, and I think we can go even as low as close to $3. I would not be surprised by that. But at the same time, I think a better way to play this is through the copper gold ratio, which is multiplied by 100 on this chart. And this level, in my opinion, is really critical for the copper gold ratio and the copper itself. And the ratio was unable to reclaim that level, which also encouraged our bearishness for the copper itself. And if I zoom out and maybe make chart a bit taller, you can see that there is a plenty of downside till 0.16, 0.15, and remember the chart is multiplied by 100. So that would be my target area. And, I have no reason to be convinced that the ratio must drop there. But if we get a breakdown below the low from May, then that would definitely be on the table, the area between 0.
So why not short copper positions with that outlook?
Because by using gold, you are basically hedging. Just give me a second to think through it. The lower volatility is definitely the reason number one. But in my opinion, you are hedging against if gold is sensitive to rates.
Well, you showed that copper chart, and I just threw a dime out there, and you started talking about prior lows. I think that's March's lows out there. That's a big trade from here still.
Yeah, I think the reason.
So is it just risk aversion? Why not get short copper? All your stuff is saying it's going down.
Yeah, it is definitely mostly about the risk aversion, but also by shorting this chart, you are basically shorting copper and buying gold, which provides certain,
lower risk trade.
Lower risk and protection against, for example, some banking risk or systemic risk, because in such a scenario, copper will definitely drop much faster than gold, because gold would be bid because of the banking or potential banking crisis. So that, I think, would be the main reason for sticking with the ratio instead of the copper itself. But even the copper itself is fine. So
Okay.
Yeah, so yeah, that's probably the reason number one. But at the same time, copper is no longer overbought, because when you take a look at the commitments of traders data, you can see the positioning is rather neutral, maybe even slightly oversold or becoming slightly oversold, at least by looking at the net positions. The net traders indicator is looking better. It shows that the market is still slightly overbought, but there is no extreme positioning right now, so that is something to keep in mind. But the relationship between positioning and upcoming price move is quite loose. So the price reaction can be much more dramatic than the reaction in positioning. So that doesn't rule out drop below the previous low in May. But obviously, the $3.50 is the first target, and if that breaks, then, as I said, the prices closer to $3 are likely. So
okay, a view on the dollar and yields. We could wrap it with one or the other.
Regarding the dollar, I remain bullish. I have personally built a massive long position on the dollar between 101 and 102. And when I take a look at positioning in the dollar, you can see that it is still pretty much oversold. There has not been a significant reaction to the rally.
No.
We are starting to see first signs of reaction or long covering in the euro, which is here. Finally,
so now so all the longs are finally giving up the ghost on the euro now.
Okay. Yes, they were holding steady till the beginning of September, but finally last week or the data from last week revealed that they are starting.
Must be time for a reaction then.
Yeah, they are starting
they're gone.
to pair their long positions, but The dollar itself remains still quite oversold.
Targets? Any
Uh,
targets for it?
well, maybe the first obvious target is, in my opinion, somewhere below 110, because
Okay.
everyone has 110 in their crosshair. So I would stick with something like this, 109. That would be
Yeah,
my
that's
first.
61.8 back 109.
Really? Oh,
Yeah.
that's even better. So that would
Yeah.
be my first target, and then I
Okay.
will reassess the positioning, and also the rates, especially the short-term rates or expectations for short-term rates, are trending up. I mean,
Yeah.
the SOFR spreads are trending higher, and this is also supporting the dollar, as you can see on this chart. So I have no reason to believe the rally on the dollar is over. Of course, there can be a consolidation or a correction, but unless the data deteriorates, then I will stick with the dollar. And I'm personally stuck in T-bills, and I have no desire to change this right now.
Okay. So Pavel, best way for people to follow your work?
Sure. You can go to our website, to spreadcharts.com. You can sign up for our software and other services. We have also a free version of the app that you just saw, and it's pretty powerful even in the free version. But also you can sign up for the premium offering, which is not just the software and advanced features in the software, but also research and some signals powered by artificial intelligence that help us to spot potential opportunities in the markets. So just spreadcharts.com.
Okay, Pavel. Well, Pavel looks for the most conservative way to, take risk out of narratives, and he's very good at what he does. And consider him for your intelligence gathering. And go to his website, check it out. Pavel, thank you for your time today.
Thank you,
You know
Dale.
what? It's wisdom that if you don't see anything like you were talking about, when I find myself searching for things to talk about and things to do, there's probably nothing to do. And it's an uncomfortable feeling, right? But
You
if you're
know,
patient,
you
it's
know,
not. It's
it's
good.
I would not say it. I would say it's not that uncomfortable because I'm getting paid 5% per annum for doing nothing, so I don't complain. If
Okay.
you know what I
All right.
mean.
Yeah, I do. Yeah, T-bill rate.
So
So, I'm just saying that, people want actionable ideas. So if you're patient, something will hit you right in the face. It'll be so compelling, you'll be compelled to take risks. So, um, nice discipline and demeanor about the markets. No FOMO for Pavel.
yeah, thank you, Dale.
All right, buddy. So I'll be in touch with you. We'll talk. You know, uh, Early winter,
Yeah,
and I
great.
bet you have a few trades cooking then.
Thank you, Dale.
All
So
right.
looking
So
forward to it.
Pavel Hala, follow Pavel at spreadcharts.com on Twitter. And that's going to be a wrap. Everyone, I hope you did okay during a little bit of a glimpse of what a liquidity crisis looks like on your screen today. And have a great day. Don't just count your pips, count your blessings. People are thanking you, Pavel, and you could join the team in 16 minutes on the morning edge. We'll wrap it up tomorrow. TGIF tomorrow. Okay, feels like Friday today, Warriors.
Mhm.
Keep your battle dress on one more day and then watch football. All right. Adios, everyone.
Bye,
Thanks,
Dale.
Pavel.
Thanks. Bye.
Thank you, buddy.
Hey traders, this is Blake Morrow with Forex Analytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.